Now, with a surge in a certain type of car sale, more and more buyers finding big savings right now. So what's fueling the buyer's market? ABC's Marcy Gonzalez on getting the most for your money.
Used car sales revving up, expected to hit record levels.
They said EVs were the future. They didn't tell you about the 2 million nobody wants. Dealer lots overflowing, factories still pumping, and families caught in the crossfire of a market that's cracking wide open. So what does it mean when brand new cars lose value overnight? Why is this being covered up? And what happens when the crash ripples into your paycheck? Stay, because the truth is darker than the ads ever showed. Dealership overflow. 2 million unsold cars are now clogging dealer lots across the United States, and many of them are electric vehicles. Walk through certain dealerships in Michigan or California, and you can see it with your own eyes. Endless rows of shiny EVs with dust forming on the windshields, plastic still wrapped around the seats, and not a single buyer in sight. For dealers, these silent machines represent not progress, but paralysis. Each day they sit unsold is another day of financing costs piling up, another dent in the fragile confidence of an industry that had banked everything on rapid adoption. The metaphor that dealers now use is blunt. It feels like standing behind a dam with cracks widening every hour. Inventory has surged to historic highs, with electric vehicles in particular now sitting more than 100 days on average before moving off lots, compared with a traditional industry benchmark of 60. That kind of backlog does not simply suggest a hiccup. It signals a system under stress, a buildup of pressure that must release somewhere, somehow. Consumers are aware of the stalemate. Many hesitate, worried about falling prices, wondering whether to buy now or wait until the inevitable discounts arrive. And still, the cars keep coming, shipped in by the thousands each week. But price pressure was about to bend the market out of shape. Market distortion. Oversupply is not simply about excess vehicles. It is about the way too much stock begins to warp the market's internal compass. With rows of EVs unsold, the normal rules of pricing and resale begin to collapse. Residual values for electric vehicles are tumbling, leaving leaseholders shocked when their cars are worth far less than projected after only a few years. Used car markets, which once stabilized the industry, are now destabilized as dealers/values to make space for yet more inventory. Imagine a reservoir filled far beyond capacity. Instead of flowing smoothly, the water turns turbulent, spilling unpredictably and eroding everything around it. That is what this oversupply does to the pricing structure. A new EV purchased today might lose 20 or 30% of its value within months, not years, because the downstream market is saturated. The usual depreciation curve has been replaced with a cliff. For ordinary families, this uncertainty is paralyzing. Should they take advantage of falling prices now, or do they risk being punished when resale collapses even further? Every household decision becomes a gamble, and few are comfortable placing bets when the stakes are this high. The effect ripples far beyond showrooms, touching insurance premiums, financing terms, and the willingness of banks to back loans for vehicles whose future value cannot be trusted. And this was not just an American problem. It was global. Liking this breakdown? Smash that like button and drop a comment with a worst truck you've ever owned. Your story might make it into our next video. Global production surge. Factories across Europe and China continued to churn out electric vehicles at a blistering pace, as if demand were infinite. New production lines opened in Germany, Poland, and Spain, while Chinese giants in Shanghai and Shenzhen doubled capacity, encouraged by government targets and heavy subsidies. But the wildfire of production was running far ahead of the forest of demand. Forecasts showed the mismatch with brutal clarity. Global EV output was expected to exceed 15 million units in 2024, while actual consumer demand was projected at barely 10 million. By the middle of the decade, analysts warned the gap could balloon to 20 million vehicles, more than the market could absorb. Each plant that expanded capacity fed the fire further, and the flames of oversupply began to scorch balance sheets. The metaphor of a wildfire is apt. What started as a controlled burn to accelerate adoption had now leapt containment lines, spreading uncontrollably. Automakers believed that by building more, they would bring prices down and consumers would follow. Instead, they created a glut that undermined trust in the product itself. When buyers sense desperation in pricing, confidence wanes, and what should be a symbol of innovation starts to look like a liability. The numbers were stark, but the consequences were human, and the human cost was about to surface. Worker unease. In towns built around the auto trade, from Detroit in the United States to Wolfsburg in Germany, the tremors of the electric oversupply crisis were felt first by workers. Shifts were cut quietly, overtime vanished, and whispers of temporary shutdowns circulated through factory floors. For the families who depended on those steady paychecks, every rumor felt like the ground shifting beneath their feet. The earthquake metaphor captures the moment well. A global oversupply thousands of miles away in China could suddenly shake the lives of welders and machinists in Ohio or Bavaria. Local diners grew quieter as lunch crowds thinned. Small businesses that thrived on the custom of auto workers, dry cleaners, mechanics, corner shops sensed the instability immediately. When one shift disappears, a whole ecosystem feels the aftershocks. Emotions ran raw. Workers asked why they were being punished for a strategy set in motion in distant boardrooms. They had built the vehicles they were told the world demanded, only to find those same cars parked unsold, becoming symbols of corporate miscalculation. Anxiety was not contained to factories. School boards worried about shrinking tax bases, and mayors feared a return to the hollowed-out economies of past industrial downturns. This was no longer an abstract issue of inventory charts or production graphs. It was a crisis seeping into the daily lives of ordinary people, breaking the illusion that the transition to electric would be smooth or painless. But the corporate boardrooms were not going to stay silent. Manufacturer retrenchment. Automakers faced the harshest truth of all. Forecasts had to be slashed, plants idled, and once celebrated models quietly canceled. Boardrooms that only a year ago brimmed with optimism now felt like control rooms of engines sputtering mid-flight. Executives stared at charts showing red ink spreading faster than they could issue memos. Shareholders demanded action, but survival meant slowing down an industry that had built its reputation on acceleration. Announcements came one after another. A major European automaker trimmed production targets by hundreds of thousands of vehicles. An American giant suspended construction on a new battery plant, citing market uncertainty. A Japanese competitor shelved plans for 2 new EV models scheduled for release in 2025. The retrenchment spread like a contagion, a recognition that oversupply could no longer be ignored. Inside companies, the chaos was palpable. Middle managers scrambled to realign supply contracts, negotiating with parts suppliers who suddenly had no orders to fill. Marketing teams were told to freeze campaigns. Engineers, once tasked with designing the next breakthrough, were reassigned to efficiency reviews. The once roaring engine of industrial progress had stalled on the highway. And when production slowed, a new kind of battle began on price. Price war gambit. The next act unfolded like a high-stakes poker game where every player feared folding but could not afford to stay in. Tesla fired the first shot, cutting sticker prices by 20% in North America. BYD, emboldened by its lower cost base, followed with even deeper discounts in Asia. Suddenly, the rest of the table had no choice but to play along. Rivals from Detroit to Stuttgart announced hurried markdowns, slashing thousands off vehicles that only months before were touted as premium offerings. Consumers cheered, waiting lists evaporated, and buyers who once thought EVs were unattainable suddenly found deals too good to ignore. Social media lit up with proud posts of discounted cars rolling off lots. For families, it felt like a windfall, but inside the industry, the celebration masked a grim reality. The profits that funded research, battery development, and charging networks were vanishing overnight. Margins collapsed at a pace few had predicted. Smaller companies, already stretched thin, began bleeding cash. Analysts warned that some might not survive another fiscal year. Price wars may thrill the public, but they leave wreckage in their wake. Factories without reinvestment, projects starved of capital, and entire brands weakened. The poker game analogy became painfully clear. The chips on the table were jobs, technologies, and futures. And on the shop floor, the fight turned into protest. Union uprising. Unions, already wary of the electric transition, seized the moment to demand accountability. The battlefield was not in distant markets, but in streets outside factories, where chants echoed against steel gates. Workers marched with placards declaring that they would not bear the cost of corporate miscalculation. From Detroit to Turin, from Birmingham to Seoul, demonstrations flared. The anger was multi-layered. Some workers were furious about plant closures that left communities hollow. Others railed against wage freezes imposed while executives collected bonuses. Still others saw automation creeping into production lines, replacing skilled labor with silent robotic arms. Each grievance converged into a common rallying cry. The promise of the EV revolution was being paid for with human sacrifice. Union leaders framed the struggle in martial terms. Negotiation tables became trenches. Collective bargaining became a siege. Companies that refused concessions faced strikes that halted entire supply chains. The battlefield metaphor fit perfectly. Both sides entrenched, both unwilling to yield. For workers, the battle was about dignity and survival. For executives, it was about maintaining flexibility in a collapsing market. And the political class could not ignore the firestorm. Political firefight. Policymakers who had once spoken with evangelical zeal about electric mandates now found themselves on the defensive. aggressive. Subsidy programs were questioned, targets revised, and legislative hearings filled with heated debate. The rocket that was supposed to propel nations toward a green future suddenly looked off course, sputtering as it left the launch pad. The dilemma was brutal. On one hand, governments had promised ambitious climate goals, staking credibility on rapid decarbonization. On the other, they now faced mass layoffs, shuttered plants, and angry unions demanding protection. Every decision carried accusations: betray workers or betray the climate. Some legislators called for pausing EV mandates entirely, while others insisted the crisis was temporary and retreat would doom the planet's future. Emotions ran high. Lawmakers accused rivals of selling out to lobbyists. Activists accused governments of cowardice. Markets watched nervously, knowing that every policy statement could swing valuations by billions. Analysts described the moment as a political firefight with no safe cover. In Washington, Brussels, and Beijing, the same question echoed. Had the rush to electrify been too fast, too aggressive, too blind? But what began as a policy debate soon shook global markets. Investor shock? On Wall Street, in Frankfurt, and across the financial capitals of the world, the alarm bells began ringing. Billions of dollars were stranded in gleaming electric vehicle plants that now looked like monuments to overconfidence. Analysts downgraded automaker stocks almost daily, wiping billions more off market capitalization. Initial public offerings, once scheduled to showcase ambitious EV startups, were quietly delayed or scrapped altogether. The market, which had treated electrification as a golden ticket, now resembled a sinking ship. Investors scrambled for lifeboats, looking for safer harbors in energy storage, semiconductors, or even traditional oil and gas. The numbers were staggering. Some companies saw valuations collapse by 30 or 40% within months. Venture capital funds that had poured money into battery innovation froze new rounds of financing. Pension funds, always cautious, began reducing their exposure to automakers that just a year earlier were touted as long-term growth bets. The promise of electrification now looked like a bubble, deflating in real time, and fear spread faster than any quarterly earnings report could calm. Credit rating agencies joined the storm, downgrading automakers once seen as untouchable. Each downgrade felt like another hole in the hull, letting water rush faster into the sinking ship. Investors who had once fought for allocations now scrambled to dump shares, fearing they might go down with the vessel. This was more than a correction. It was a structural revaluation of the future. The bet on mass EV adoption had capsized, and investors who had once spoken with evangelical zeal about the green transition now muttered about sunk costs and exit strategies. But in Asia, oversupply did not just spook investors. It turned into a weapon. Asian export flood. Chinese automakers, armed with state support and vast economies of scale, saw opportunity in the crisis. Factories that could not sell into a saturated domestic market turned outward, flooding Europe, Latin America, and even the United States, with vehicles priced so low that rivals could barely respond. It was not just commerce. It was a tsunami designed to reshape the competitive landscape. Shipments of compact EVs landed in European ports at price points 20 or 30% below anything German or American manufacturers could match. For Western brands, the effect was devastating. Centuries-old manufacturers suddenly looked fragile. Their profit margins drowned under a wave of cheap imports. Dealers in France, Spain, and Italy openly admitted that Chinese vehicles were eating their lunch. The competitive gap was no longer about quality, but about cost, and the flood showed no sign of receding. Ports themselves became symbols of the flood. Long lines of ships unloaded wave after wave of compact EVs, overwhelming storage yards. Local officials warned that the volume was unprecedented, straining infrastructure and customs systems. What looked like a commercial surge increasingly resembled a geopolitical strategy executed with ruthless precision. The emotional toll was palpable. Executives in Stuttgart and Paris warned of existential threats. Governments worried that once consumers grew accustomed to cheaper Chinese EVs, local industries would never recover. Engineers who had once spoken with pride about precision design now whispered about irrelevance. It was not just cars arriving on ships, it was a strategic export offensive with geopolitical implications. And governments reached for the oldest weapon in the playbook: protectionist counterattack. The response came swiftly. Tariffs, subsidies, and quotas dusted off from the toolbox of 20th century industrial policy. The European Union announced new import duties on low-cost Chinese EVs, citing unfair state subsidies. In Washington, lawmakers pushed for stricter Buy American rules to shield Detroit's fragile balance sheets. Even in countries historically committed to free markets, murmurs of protectionism grew louder. The shield metaphor defined the mood. Nations that had once embraced globalization now raised barriers, hoping to slow the tide. Trade wars threatened to flare, and diplomatic meetings grew tense. Beijing accused Western governments of hypocrisy, pointing out that subsidies had long propped up their own industries. Brussels countered with accusations of market dumping. The rhetoric sharpened, and the global auto industry found itself at the heart of a new trade conflict. Automakers lobbied fiercely behind closed doors, pressing governments to act decisively. Executives argued that without barriers, entire domestic industries could vanish within a decade. Their rhetoric painted tariffs not as economic distortions, but as survival shields, necessary to preserve national pride, industrial identity, and millions of threatened manufacturing jobs. The analysis was sobering. Globalization, at least in this sector, was running in reverse. Instead of seamless supply chains, countries braced for fragmentation. Instead of open markets, the future hinted at blocs competing with shields raised high. What was meant to be an era of shared innovation risked devolving into a zero-sum contest of survival. But for ordinary families, the battle came down to a choice in the showroom. Consumer dilemma. For households, the glut translated into an unexpected and confusing reality. Cars that once carried price tags far beyond reach were now offered at discounts that felt too good to pass up. A family in Ohio could suddenly consider an EV for the first time, while a young couple in Milan debated whether to grab a deal on a Chinese compact. Yet beneath the excitement lay a swamp of uncertainty. Resale values for EVs plummeted, leaving early adopters underwater on their loans. Insurance companies hesitated, raising premiums for vehicles whose long-term worth was unknown. Consumers who jumped at bargains worried about spare parts, software updates, and whether their chosen brand would even exist in 5 years. What felt like a short-term win risked becoming a long-term trap. Dealers themselves admitted confusion. Some warned customers that buying too soon could mean devastating depreciation, while others pushed aggressive promotions to clear inventory. This tug-of-war left families feeling manipulated, unsure whether advice was genuine or desperation. In the swamp of uncertainty, trust between buyer and seller steadily eroded. The emotional debate played out around kitchen tables everywhere. Parents weighed lower fuel bills against fears of being stuck with a car no dealer would take back. Young professionals balanced climate ideals against the risk of financial loss. Every decision felt like wading into a swamp, tempting paths forward, but every step threatening to sink. And behind the noise, the whole industry began to reorder itself. Industry consolidation. The oversupply crisis forced a reckoning that reshaped the industry itself. Stronger brands absorbed weaker rivals, while others simply collapsed under the weight of unsold stock and evaporating capital. Bankruptcies mounted, some quiet and procedural, others dramatic headlines that shocked loyal customers. For decades, familiar badges had symbolized trust and identity. Now they vanished from highways and driveways as though erased overnight. Survival of the fittest became more than a metaphor. It was the new market law. Companies with deep reserves, diversified operations, and the ability to cut costs without imploding gained ground. Tesla, Volkswagen, and Toyota weathered the storm, but dozens of smaller ventures and startups failed to find footing. The promise of variety that had once defined the electric revolution narrowed, leaving fewer but bigger players to dictate the terms of progress. The mergers were not always triumphs. Some felt more like funerals, with proud legacies absorbed into faceless conglomerates. Employees spoke of heritage erased overnight, design philosophies abandoned, and community ties severed. Consolidation promised efficiency, but for many, it looked and felt like cultural extinction masquerading as market logic. The emotional weight was heavy. Communities tied to once iconic automakers watched with disbelief as factories closed and brands dissolved. Consumers, too, felt the sting, forced to abandon loyalty built over generations. The electric vehicle industry, once celebrated for innovation and diversity, began to resemble an oligopoly, with power concentrated in the hands of a few. But consolidation was not just about brands. It shook the entire supply chain. Supply chain earthquake. The tremors of consolidation rumbled deep into the global supply chain. Demand swings sent shockwaves through the markets for metals and minerals that powered the EV revolution. Lithium miners in South America and Australia became winners, their product still essential despite the slowdown, while nickel suppliers, overbuilt and overleveraged, suffered steep losses. Cobalt producers in the Democratic Republic of Congo faced volatility as automakers shifted chemistries to cut costs, leaving entire regions destabilized. The fault line metaphor became reality. Supply chains cracked under the stress. Some commodity prices soared as investors sought stability, while others cratered, wiping out billions in value. Countries in the global south that had bet heavily on mineral exports saw budgets shredded and social programs threatened. Local economies dependent on mining jobs faced sudden layoffs, adding a human cost to the economic quake. Smaller suppliers, often family-run firms producing niche components, were hit the hardest. Without the capital reserves of larger corporations, many closed their doors within months. Their disappearance weakened resilience, leaving the entire supply chain more brittle. What had once been a web of interdependence began collapsing into fragile bottlenecks. The data was stark. Trade volumes for certain battery materials dropped by more than 20% within a year. Shipping routes, once dominated by container after container of EV components, ran half empty. What had been projected as a secure growth path turned into a roller coaster of instability. And with supply chains in flux, the climate debate turned bitter. Climate and transition reset. The crisis forced governments and climate advocates to confront uncomfortable questions. Ambitions for a rapid green transition, once seen as unassailable, were being rewritten under the pressure of oversupply and economic backlash. Mandates that required steep increases in electric vehicle adoption suddenly looked unrealistic. Calls grew louder to slow the pace, extend deadlines, and redirect subsidies toward infrastructure rather than production. The crossroads metaphor captured the mood. Policymakers faced two diverging paths: stay the course and risk deeper industry turmoil, or reset expectations and face accusations of betrayal. Some governments began pivoting subsidies toward charging networks, arguing that infrastructure, not production, was the true bottleneck. Others floated hybrid incentives, keeping combustion engines in the mix longer than activists had hoped. Public trust also began to fracture. Surveys showed that many drivers no longer believed the transition would be fair, fearing they would shoulder higher costs, while elites reaped subsidies. The sense of injustice deepened political divides, turning what began as an economic debate into a cultural and identity battle. Emotions ran high. Climate activists accused leaders of cowardice, warning that any slowdown would doom international agreements. Industry representatives countered that ignoring market realities would only destroy jobs and hollow out economies. The public watched uneasily, caught between fears of economic decline and hopes for environmental progress. And as the debate grew more divisive, investors read the writing on the wall. You've reached the end, but the ride isn't over. Hit subscribe now, join the community, and be first to catch every hidden truth the truck world doesn't want exposed. Investor landscape? For investors, the oversupply crisis redrew the chessboard. Billions of dollars were lost in bankruptcies, devalued plants, and canceled projects. Funds that had staked everything on EV startups liquidated at a loss, while larger institutional investors quietly pivoted away from automakers. The old EV bets had soured, but the game was not over. Capital was simply moving to new pieces on the board. Attention shifted to software firms that could optimize fleets, to after-sales service companies promising stability, and to battery recycling ventures that looked like the next gold rush. Investors fearful of another collapse became cautious, but opportunistic, hunting the next prize with wary eyes. Every move was strategic, as if played on a chessboard where one misstep could cost entire portfolios. The emotional tone was cautious resilience. Yes, fortunes had been lost, but new fortunes could still be made by those who adapted fastest. Venture capital that once celebrated disruption now prized durability. Pension funds sought companies with diversified exposure, betting on resilience over hype. This was not the end of electric vehicles. It was the end of the EV story we thought we knew. The narrative had shifted from boundless optimism to careful recalibration, and nothing about the industry would ever look the same again. The oversupply crisis isn't just an industry headline, it's a turning point that will shape your wallet, your job, and the future of mobility. Now you know what's really happening behind the glossy ads and promises. Don't keep this to yourself. Share it, because people you know are already being affected. Drop your thoughts in the comments, because this fight is far from over. And if you want the truth before it hits the news cycle, hit subscribe now. Stay with us, because the next chapter is already unfolding, and you can't afford to miss it.